So we want to welcome everyone to webinar number 18. Crazy, we've did a lot of these webinars last year, of course, with COVID. It was my mom's idea, and happy to be back for another one here. As many of you know, it's been a busy spring in the office here. 3 new babies. As well as doing a lot of spring reviews with clients. So we had to take a short hiatus away from doing these webinars, but it feels good to be back, joined by Patrick Gall.
Yeah, it is good to be back. Real quick, if anybody's having a hard time hearing Johann or something cuts out, just shoot me a message at info@oceansideadvisors.com. I'd be happy to help, fix the problem, whatever way I can.
All right, so today's topic, should your portfolio change with inflation looming? One of my favorite parts about doing these webinars is it forces me to dig into research, both old research, new research, to really make sure we're doing everything as well as we can for clients and the way our portfolios are structured. And so it's I really enjoyed kind of preparing for this one. So before we get started, just a quick disclaimer, as always, through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. Information provided is for informational purposes and does not constitute financial, tax, or legal advice. Of course, we would love to give you this advice, but we need to get to know you a little bit better before we're allowed to provide that fiduciary guidance. All right, so our goals today. Learn about inflation and how it impacts certain investments and portfolios. What is inflation? What causes it? Is there an ideal inflation hedge? We're going to look at the performance of different asset classes in inflationary environments. And then we are going to end with some ideas on how maybe you should be invested today. But just to point out, I think Patrick might have mentioned, but there should be a little Q&A down at the bottom. So if we have some time to take questions, you can fill in those questions anytime throughout the webinar, and then we'll try to get to as many as we can at the end. All right, so what is inflation? Inflation is the general rise in prices for goods and services over time. Okay, stated quite simply, it means you can buy less with the money you've saved. All right, this picture on the right, a client sent this to me this week. I think it's been floating around social media as well. But of course, on the left here, it shows how much lumber 1,000 US could buy you last fall. So it looks like a good bit of plywood underneath there, and then however many 2x4s that might be up top, versus what $1,000 of how far $1,000 could get you in lumber today. So lumber, of course, has inflated a great deal. There's been a lot of conversation surrounding building prices, but in a nutshell, this is a great example of what inflation looks like in very practical terms. I just updated this morning when I was preparing for the webinar. I had the April CPI figure year over year. We were at 4.2% in last month's reading, and then I came in about 2 hours ago at 8:30 Eastern. They just released the May CPI, so I edited this. Surprise to the upside, 5% year over year. So on average, goods and services cost 5% more than they did just 12 months ago here in the United States. Average inflation rate in the US since the year 1900 has been right around 3%. Average inflation more recently in the past 20 years has been about 2%. All right, so that's what inflation looks like. Certainly, there's been an uptick recently. What causes inflation? Quite simply, too much money chasing too few goods. All right, now I wasn't around quite yet in the 70s, but I've studied it quite extensively. So what causes inflation? An increased money supply. So a lot of it can be driven by central bank policy around the world. Lending by banks, of course, like those loans are ultimately what creates new money into the economy. Pent up demand. All right. So, for example, the whole world is locked down in a coronavirus pandemic. People, as the world opens up, people want to get out, right? They want to go on trips that they weren't able to go on. They want to go to restaurants, and so there is a lot of pent up demand. Also, capacity constraints can drive inflation, right? So I'm sure some have heard about, there's a big chip shortage. If those of you trying to buy appliances or vehicles these days, there's shortages there, as well as labor shortages. All right, so a lot of you're hearing a lot of conversation. Is it possible a recurrence of late 1970s inflation looming? And I just want to point out, like, the purpose of this webinar is not to forecast inflation rates or how persistent that inflation might be. There's tremendous data that economists are very bad at predicting inflation and how long it's going to last. It's very difficult to do. So we're going to try to stay away from that. However, it's quite apparent from today's CPI number, last month's CPI number, that it's definitely here. So it's just a matter of how long it might last, how sharp the increase might be. With that being said, I did think it made sense to highlight some reasons why the looming inflation may not be as bad as some predict. Capital Economics came out with a report that was trying to draw similarities and differences between the 1970s and today, because a lot of these reasons, like, you're probably not going to see in the media, right? The media drives, they like driving fear so they can sell products like gold and whatever else is being sold out of trying to get people scared to purchase certain things. So I thought it made sense to just spend a couple minutes, like, why it may not be as bad as some predict. Okay, so for one, there was much less globalization in trade in the 70s. Okay, so today's companies can much more easily move production overseas to keep costs lower. Back in the 70s, the U.S. GDP, gross domestic product, only about a quarter of it came from international places, whereas today's number, it's about half of our GDP. All right, so much more globalization where we could produce things in a country somewhere else to keep costs potentially lower. Unions were much more powerful in the 70s, right? So there's a lot more bargaining power to increase wages. People were more willing to go on strike. And this third one's probably the biggest one, but there's much greater potential for higher productivity today, just due to the improvements in technology. So this also could put downward pressure, maybe put a cap on what inflation might be in the near to intermediate term. One thing I didn't put on here, but Capital Economics pointed out, in the 1970s, the Federal Reserve was very hesitant to raise interest rates in the face of inflation. Okay, so they weren't But frankly, they weren't sure it would work to fight inflation. And it wasn't until Paul Volcker came in the 80s and started hiking interest rates, which ultimately squashed inflation that whole time period. So the reason I didn't put it on there is I'm not entirely convinced that our Fed would be crazy about raising interest rates either. But that would be like the fourth point. Capital economics, they thought that the Federal Reserve today, if inflation gets out of hand, would act more quickly to fight those inflationary pressures. All right, so why can inflation be harmful to investment portfolios and retirement plans? I'm going to start with a question, and obviously the title of the webinar today might give this part of this answer away. But when was the worst time in U.S. history to retire? If we weren't doing a webinar on inflation, the question, the answer we usually get, it's like, probably 2000, right? Because you have the dot-com crash, you had 9/11, you had the global financial crisis. That would be a tough year to retire. But of course, the real answer is 1966. And then you say, well, how can that be true when the US stock market averaged almost a 7% a year return between 1966 and 1982? And of course, the answer, well, inflation also averaged about 7% a year in that same time period, meaning the real, which that just means the inflation adjusted return, was essentially zero for that time period. So first thing, I know listeners of our educational content webinars like this, it's many times a wide range of education and how much experience you have with these things. So just wanted to quickly point out the difference between what a nominal return and an inflation adjusted return means. Okay, because ultimately it's real returns, right? Inflation adjusted returns, like that's what really matters. Like at the end of the day, you need to use your savings, your portfolios to fund your lifestyle and your everyday expenses. So if it costs more to fund those things, you need a higher return, right? So that's why the real return is what's most important when it comes to investing. So here's just an example. Asset class returns, basically about the last 90 years. Okay. So the darker blue, these are nominal returns. Okay, so that's just the dollar figure that you see going up or down. Nominal returns for 5-year treasuries in this 90-year time period, 5.2%. Okay, but remember, if you think back to a slide we showed towards the beginning, we've averaged about 3% inflation long term, right? So therefore, like the real return that you're truly experiencing, the real return, this light blue, 2.2%. Okay, in the U.S. stock market, close to a 10% nominal return. But again, you got to take the 3% off to account for inflation. So your real return closer to a 6-7%. Okay, here if you want a diversified mix of stocks, which we'll talk about that in a little bit, but a little bit higher return, about 11.5% nominal, real return of about 8.5% per year. So difference between nominal and real inflation adjusted returns. A couple other more important points that we have to make in order to understand some of the interaction between inflation and markets. Okay, the first, and a lot of people don't understand this, but when you go and buy a stock or a bond today, like current inflation expectations are already built into the price of those securities. Okay, and that's done through like the discount rate, and we'll touch on that in a little bit, but big point is just current inflation expectations are already built into today's prices. However, excessive and unexpected inflation, this is where things become problematic because they are not yet priced into securities. Right now, unexpectedly high inflation benefits borrowers at the expense of lenders. All right, so When unexpected inflation arises, what happens is lenders have to increase the cost of borrowing, right? Which can reduce economic activity. This is also where the Federal Reserve comes in. They increase the cost of borrowing, and so you can see how that can spiral and dampen economic activity. That's what inflation does. Okay. So most traditional asset classes perform quite poorly during inflationary periods. Okay, so just starting with domestic equities, just some interesting data. I like this study a lot. So since 1952, in periods where CPI, so the Consumer Price Index, is 1% greater than the 5-year running average, okay, the average stock return is negative. Okay, so down about 1.5%. Okay, and so the reason, and maybe if you don't have a background in finance, maybe just plug your ears for 30 seconds to a minute here. But again, it gets back to this discount rate, because the way securities are priced, right, whether it's a stock or a bond, really, like the value of anything, it's the present value. Okay, so we're trying to find the present value, and in order to do that, we're taking the expected future cash flows, and then you have to divide by a discount rate. Okay, so a discount rate is sometimes referred to as a cost of capital. And so what happens is, as inflation expectations rise suddenly, investors, market participants, they're going to demand a higher return, right? Because they're concerned about the real return, right? So as inflation expectations rise, that discount rate in the denominator of the equation, that rises, right? So if the numerator, which might be cash flows, and even if a company is able to pass through the higher prices through inflation to the consumer, the problem is usually that denominator, the bottom part, the discount rate rises with inflation at a much higher rate. And therefore, in the equation, right, the higher denominator means prices go down. So that's kind of like the math and kind of the finance 101 behind why inflation is not good for most traditional asset classes. Okay, and then so conversely, like in periods when CPI is 1% less than the 5-year average, well, this works out pretty nicely for stocks, right? Because now we have an average return about 14%. So it's quite apparent. Equities on average prefer the lower inflation than when you have unexpected higher inflation. Okay, fixed income, so bonds. A lot of people don't understand that bonds actually tend to perform worse than stocks during most periods of high inflation. Okay, certainly in real terms, right? In real terms. So purchasing power is significantly reduced, as well as kind of fixed income 101. We know in inflationary environments, you usually see interest rates rise eventually. We know that as interest rates rise, fixed income prices, bond prices go down, right? So there's an inverse relationship. So your bond prices, especially longer duration bonds, okay, that just means bonds that don't mature for a number of years, they will lose value. Another way to think of it, remember, if you're a bond holder, you're the lender. Remember, inflation punishes lenders. So if you're a bond holder, you are a lender that's giving money to whatever corporation, whatever company that's borrowing from you. That's what a bond is. Okay. All right. So knowing that traditional asset classes perform quite poorly during inflationary periods, like what asset characteristics would provide the ideal inflation hedge? All right. So the first thing that we would look for, that asset would correlate positively with inflation, as well as it would respond to unexpected inflation. Okay, that's the second thing that we would really want. The asset would not be too volatile. And lastly, the asset would have a real expected return that's greater than 0. Okay, the problem with this is that this asset does not exist. That there is not an ideal inflation hedge. Okay, and Ken French, who's one of the brightest minds in finance, he wrote a ton of the books that I've studied. I'm sure some of you might be familiar with, the Fama French, the factor models for asset pricing. But he said, like, who would take the other side of that trade, right? Like, who in their right mind would take the other side of that trade, of those characteristics? So the problem is that ideal inflation hedge, it does not exist. Okay. However, even though there's not a perfect hedge, there are some assets that can provide, maybe one or two of those desired hedging characteristics. Okay. The first is TIPS, so Treasury Inflation Protected Securities. All right. So these, of course, they correlate positively with inflation, right? So that's kind of like the first bullet point of the ideal inflation hedge, as the principal adjusts every 6 months. Okay, so that's pretty nice. The problem with TIPS, and those of you that study the bond market would know this already, yields on most TIPS are negative, right? So here in the United States, a 10-year TIP, currently the yield to maturity is negative 0.85. So although some investors are okay with that, like most investors aren't crazy about locking up a negative 1% return every year for the next 10 years. Not too many people are crazy about that. So yeah, TIPS might not be great for everyone. Series I saving bonds, these are pretty interesting in the United States. These pay interest based on a stated inflation rate. Okay, so these are really interesting. The downside on Series I savings bonds, okay, first of all, there are penalties if redeemed within 5 years. The other kind of inconvenience is you have to purchase these through the Treasury. They're held at Treasury Direct. So yeah, you can't own them, for example, at TD Ameritrade or Schwab or Fidelity. They're held in a separate account that through treasurydirect.gov, I believe it is. The other downside is you can only buy $10,000 per year. So for a high net worth investor, it would take quite a long time to build a meaningful position in Series I savings bonds. The third one I have here that's a little bit counterintuitive, but it's interesting. Short-term nominal bonds. Okay, short-term nominal bonds. Now, what's interesting about this is you earn interest, very little today, basically 0 today. But if they're short-term, meaning their duration is very short, okay, that means they're not going to depreciate. Maybe not the very little depreciation should interest rates rise if you have a short maturity. So, and then kind of the thought process being, if you can preserve the capital earning little to no interest today, like if inflation comes and interest rates rises, right? So the Fed starts raising rates. Then all of a sudden, just sitting in a short, and I'm talking like T-bills, like very short term, like eventually those short term bonds, like money market, things like that, you might be able to earn 1%, then maybe it's 2%, maybe it's 3%. So there's a lot of assumptions in this one, but from a capital preservation, you are protected in the short term. And then you just, you would need inflation to happen and interest rates to go up. And then you could be in a pretty good spot with short-term nominal bonds. The last one I have here is real estate or real estate investment trusts. So if you're able to increase rents on residential or commercial property, so again, pass through that rent inflation, that can definitely benefit and that could do well in an inflationary environment. A few things you need to be really careful with real estate or REITs. A lot of people forget about the other risks involved because they are substantial. Really need to be aware of the liquidity risk, vacancy. So if you're having a hard time finding tenants in a place, or COVID's a great example. Like, no one saw that coming, and that's why a lot of these REITs, a lot of these privately traded REITs went bankrupt and are still going bankrupt. The vacancy risk, as well as other property specific risks. So there are definitely, and there are many more, but these are just the three I thought of right away. So real estate can be a decent hedge for inflation. You just need to be very aware of the downsides as well. Okay, a question we get a lot, like, is gold a good hedge against inflation? And we touched on this in a previous webinar. We hosted a webinar titled, should I own gold, or should gold be in my portfolio, something along those lines. And so we'll just kind of run through some of the highlights here. So historically, yes, gold is a good hedge against inflation, but not really. And what I mean by that, and there's an awesome paper if you want to read this one. It's called The Golden Dilemma by Claude Erb and Campbell Harvey. Okay, and so what they found is, in the very long run, gold has proven to be a good hedge against inflation. And when I mean long run, I should say when they mean long run, they did the hard research. The wage of a Roman centurion during the rule of Emperor Augustus 2,000 years ago was about the same. That wage is about the same as today's wage of a US Army captain when both are measured in gold. Okay, also the price of bread today is surprisingly also roughly the same as 2,000 years ago when priced in gold. Okay, so in the long run, gold seems to be a great hedge against inflation. The problem is, in the short run, so like 20-year rolling periods, gold is a very poor inflation hedge. That is, it's volatile, likely to undershoot and overshoot any notion of fair value. They also concluded, even if one has a firm grasp on the probability of hyperinflation in a country, it says nothing about whether or not the real price of gold will maintain its purchasing power during the experience. And I know that's not exactly what you probably hear on some of the news networks, trying to get people to sell their whole IRAs and put it in gold using all these crazy fear tactics. Like, it's just, although that fits a nice narrative, frankly, the data doesn't back it up at all. And then lastly, it's just important to, I thought this is really, so no relationship between the price of gold and unexpected inflation. So in the short run, gold is not a good inflation hedge. It isn't. The other thing I'd point out, it's important to remember that gold, even if it has a long-term, it's a good long-term hedge against inflation. What that ultimately means is its expected return is a 0% real return, right? So you would not expect to achieve a higher in excess a return above what inflation earns in the long run anyway. Okay, so with that being said, like, and you can go back and watch our previous webinar on that, it doesn't necessarily mean you don't want to own gold in a portfolio. Okay, it's just probably not for the reason of inflation, right? Because gold does have diversification benefits. It doesn't really correlate with other asset classes, which is nice, meaning it kind of more randomly trades in different directions independently of equity and fixed income. So for someone that the risk preference is quite risk averse, gold can absolutely have, you could justify putting gold in a portfolio just for the diversification benefits, okay, of just having a safer portfolio that, if equities are crashing, gold might not necessarily be crashing. Okay, so something to consider there. Okay, so what other portfolio considerations should be addressed regarding inflation? Okay, this is one people don't think about very much, but I find incredibly important. Globally diversify your equities. Okay, although it's not a true hedge, owning international stocks can help with unexpected domestic, so home inflation. And this is somewhat intuitive. Like, if inflation in the United States does happen, like it doesn't necessarily mean that other developed economies would share the same experience, right? So thinking back to the what we started with, that example for in the US from 1966 to 1982, like that time period where the US had a 0% real return, like that was not the case in other developed countries, right? So there were a number of other developed international countries that did just fine in that same time period with higher than zero real inflation adjusted returns. So by owning, I mean, we know there's a number of other benefits for having a globally diversified portfolio, but it can even help a little bit should there be domestic inflation. Other one I wanted to point out, overweighting value companies. Okay, so again, also outside of any conversation of inflation, we know that there are benefits and excess return that can be earned by overweighting value companies. But there's even growing evidence that value companies may relatively outperform during periods of inflation. So just kind of an added bonus there, if you will. Last point is stay invested. Trying to time these things. Again, I mentioned earlier how poor economists are at forecasting pretty much anything, like whether it's inflation, where interest rates are going, where equity markets are going. Economists are notoriously poor at making forecasts. They're far better at analyzing data after the fact and coming up with conclusions like why things happen. So we would encourage most investors to stay invested and just remember, since the year 1900, so we're going back even further, equities have outperformed inflation. So a real return, that's a real return greater than 5% a year. All right. So in conclusion, looks like we're doing okay with time. In conclusion, just remember, like, current inflation expectations are already expressed in today's market prices. Unexpected inflation, this is the one that can cause problems, right? It's going to present headwinds for most asset classes and can be disruptive to the sustainability of cash flow to retirees. There's no such thing as a perfect hedge against inflation. Investors looking to protect purchasing power may want to consider TIPS, Series I saving bonds, short-term nominal bonds, and real estate and/or real estate investment trusts. Don't fall for the narrative and all the gold salesmen trying to tell you that gold is this ultimate inflation hedge and you're not going to live if you don't buy it. There's no data for that. And lastly, for most long-term investors, although it might be hopefully not a disappointing conclusion, but it's the honest one and the one supported by mountains of evidence. For most long-term investors, the best way to combat inflation is holding a globally diversified portfolio. Right, so you want to own international, you want to own some emerging markets, like we I didn't touch on it in this, but one of the largest beneficiaries of a weaker US dollar is emerging markets, right? So you definitely want to be in emerging markets. So just a globally diversified portfolio. You want to own value, you want to own some small cap, just want to be very balanced. And with that, Patrick, I think we have time for a couple of questions. And I've got a call at 11:45, but I think we get time for a couple here.
Yeah, we got some good ones coming in here. Let's go with these two that look to be pretty closely related. We got Thomas with the inflation looming, given bonds perform worse than stocks, should I still own any bonds?
She still own any bonds?
Yeah.
Okay, so this, I mean, it really depends on, again, remember, this is generic advice. Like without Thomas, I don't know your exact situation, but for many investors, especially if you're in retirement, like it absolutely still makes sense to hold bonds. For starters, like we don't know with certainty that we're going to get significant inflation. Again, those reasons we listed in the first few slides, like there's some pretty compelling arguments why inflation might not be as bad as we saw in like the 70s, right? So I actually read a paper, like some people think this is a head fake and we could get deflation, right? So, and bonds are the best thing to own in a deflationary environment. So, for Thomas, for most investors, yes, you want to own bonds. They provide income. They protect against capital losses, right? So in a big equity decline, like you tend to do okay there. It also provides you with the opportunity to rebalance, right? So we've done webinars on rebalancing as well, and why that's so important, and how you can add a ton of value. So I would say for most investors, especially if you're in retirement, you still want to own some bonds, because even if it's not completely keeping up with inflation, it's still providing income. You're still being diversified, allowing you to rebalance. And frankly, like we don't know how bad inflation is going to be. So I think you probably still want to own some bonds.
So in the same lane, Arthur asked, given all this inflation talk, is it more risky to hold stocks or bonds?
Ooh, good question. Okay, so for this, I think it's really important that you make the distinction between like investment safety versus financial safety. Okay, so like what's riskier, stocks or bonds? Well, in the near term, like a bond fund is going to be a much safer investment, right? In the near term, the bond fund will be a much safer investment. However, if your goal is, hey, I need to take principal 15 years from now, bonds are far riskier than stocks, right? So some people confuse that, and I've tried to get better at communicating this point, but in many respects, bonds are riskier than stocks in any environment, right? Like it's people confuse. There's a huge difference between like investment safety and financial safety. Like investment safety, or like what does your retirement plan, what does it need for you to succeed? Because if you need to be drawing principal when you're in your 80s or 90s for maybe long-term care or something, and you're in your 70s, like, yeah, bonds would be really risky. If you had your whole portfolio in bonds, like that's extremely risky, because if you get even modest inflation, you're going to get crushed. And so that would be far more risky than owning stocks. Hope that made sense. Anything else, Patrick?
I think so. I think it was good. I learned.
Yeah. I enjoyed researching this one. This is, as I mentioned, I kind of missed. We were so busy with new children and just busy in the office with spring reviews and everything, like I love just digging into the research and making sure we're doing the right things. And if there's something we can improve, great. So I love like looking at the new, it's fun for me. So it's refreshing to get a new webinar in for the first time in a while. So we certainly appreciate everyone joining us that tuned in to learn a little bit about inflation. Just looking at the attendee list, it's always a nice mix of people we're already helping and yeah, other people that we've met and come along for the education. So certainly if you have questions for us, don't hesitate to reach out to myself or Patrick or anyone else on the team here, Ross or Tyson. Yeah, we'd love to just continue the conversation. If you have questions about your portfolio and inflation, we'd be happy to help. So thanks for joining. And yeah, we'll be hosting another webinar sometime soon. So we hope everyone has a nice day.